Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better your retirement and your retirement portfolio. You know, 2011 is coming to an end. We are now looking at 2012. We, I believe, are well positioned, although we will be making a few adjustments come year end. That I can pretty much guarantee you. And we want to make sure we are properly set up for 2012, which I believe is going to be substantially different than 2011. We continue to receive dozens and dozens of emails and calls from our radio listeners, people just like you, who really are, they're concerned about, their portfolio. They're concerned maybe about the lack of investment management they're receiving from their so-called advisor. Or if they're doing it themselves, it's just a lot of investors emotionally distraught about, volatility. And one of the things that I'm going to tell you before I go into where I look at for 2012 is really investment strategy. If you do not have an investment strategy, and I know I talk about this a lot, but unfortunately most people need to hear the same message over and over before they finally react. An investment strategy in writing has to be followed religiously. If you do not have an investment strategy, and that doesn't mean in your head or you're shooting from the hip or you're getting tips or you're looking at day by day of the market and jumping here or there or just all emotional worried, you need to have an investment strategy. And there's times where that investment strategy short term will not work as well as you anticipated, but over that rolling 3 years, most strategies that we've looked at or have used, we find work very well. The problem that most investors face is they don't have an investment strategy if they're doing it themselves, or if they're using a so-called advisor, because most brokers or advisors are simply brokers, they're not money managers. An investment strategy needs to be detailed, you need to follow it, and it needs to be in writing. So that's tip number one for 2012. We look at 2012, and as we get close to this year end, I can tell you we look at our relative strength indicators, which every single month we do our benchmark on those, and then we reallocate our portfolio to the strongest sectors in the investment asset class category. Any investment, whether it's real estate, gold, bonds, corporate bonds, high yield, stocks, small, mid cap, all the various asset categories around the globe, not just the US, and then we rank those based upon a proprietary formula. I can tell you right now, as we're getting towards year end, we continue to be heavily weighted in small and mid cap in the US. We are not in gold currently, and things can change at any point, but what we've seen come out of Europe over the last couple weeks is actually some positives, and I talked about this a few weeks ago. Essentially what Europe is doing right now, or the ECB, is they are basically lending approximately $600 billion on a low-cost structure at a 1% level to the banks. What they're trying to do is the banks then can borrow this money at 1%. They can then go out and buy sovereign debt at 5 and 6% and make a huge spread or profit on their investment. What they're trying to do is re-liquefy the banks in order for them to make profits, and by doing exactly what they're doing, it's kind of a form of our QE2 that Bernanke and team put in place a few years ago. This should actually work, and in fact, I talked about this a few weeks ago, taking any kind of Lehman experience off the table or a collapse of the credit markets or the banking system. This is a net positive. Now, it's not that Europe isn't going to be in a recession next year, and it's not that Europe will not have a slow growth economy. They're going to be slow growth, and I believe they will be in a recession, but it will be mild. And at the end of the day, again, it goes back to those are going to be countries you're going to avoid in that Eurozone. You want to be in areas that are truly going to have an opportunity to grow. Now, we're going to look at the year end on a relative strength basis, and we're going to obviously reallocate our portfolio as we do each and every month. But at the end of the day, what you need to do is sectors that are relatively stronger than others, or investment sectors, whether that's gold, whether it's bonds or stocks, and again, all the subcategories, relative strength has been proven to be, bar none, one of the best predictors of future return. And as a sector becomes relatively weak compared to other sectors, those sectors are sold off and replaced with relatively strong sectors. What that does is it keeps you in a positive trend line, and in my opinion, keeps you out of trouble, because as a sector is falling off, it forces you, based upon your investment strategy, to get out of that. Now that's part of our GTOP portfolio strategy, our Global Tactical Opportunity Portfolio, and that's why any investment strategy, whether your strategy is on relative strength, whether it's on trends, whether it's on fundamentals, whatever your strategy is, and that's why it needs to be followed. So look at what you're doing today and really ask yourself going into 2012, do I really have an investment strategy, and is it working? If it's not working, or the advice you're getting isn't working, obviously doing the same thing and expecting different results going into 2012 is not a winning proposition. That's why, and again, I'm going to stress my number one tip for 2012 is have an investment strategy, have it in writing, and you need to follow it through thick and thin. If you don't, you will fail miserably as an investor, and that's what we find too often is people will keep doing the same things and expecting different results, and unfortunately, folks, that doesn't work in investing. What I have found is if you follow a process that's been proven to work over a period of time of 3 years or more, you have a very high likelihood then of achieving your investment goals, which is typically reduced volatility and helping to stabilize the return and consistency within your portfolio. So regardless of your strategy, you need to make sure you do have one and that you actually do follow it. As I continue down the path in 2012, I think we'll have a little bit more bumpiness in the beginning, not as much as we saw at the second half of 2011, and I think things will start to smooth out as we get into the second half of 2012. I believe 2012 is going to be set up for investors who are in the right areas to do exceptionally well. The areas that I would tell you that you truly need to avoid are long-term bonds almost at all costs. The risk differential between opportunity of making a return on long-term bond investments, whether those are individual bonds, bond funds, or ETFs, are going to be slim to none, and the downside risk is huge. If rates start to tick up at all, or the anticipation of that over time, meaning looking out a year or two out, they could already anticipate that long-term bonds will really get hurt. If the economy continues to stabilize and get just a little bit better, again, another reason why long-term bonds will then fall in value. So what I would suggest is one of the categories, I think it would be one of the worst performers, and one of the areas that I would definitely avoid are long-term bonds. Not short-term, not intermediate term, but strictly the longer-term category. A couple areas that I think on the equity-based side in general, again, this is on our relative strength right now, and that will change over the months and quarters into 2012. Again, the small and mid cap in the U.S., and what we're doing, we're starting to see a resurgence in the emerging markets. Emerging markets in 2011 were horrifically bad, but we're starting to see a comeback. If I look at where the true GDP growth is going to come from, it's going to come from a lot of these emerging market economies. And what's interesting is most of the emerging market economies, while they are slowing down somewhat, they have the ammunition and the firepower to stimulate their economy much more than any other place on the globe. And what that means is they don't have the debt, they have the cash, they have the higher interest rates, they can do monetary policy easily and quickly in order to stimulate their economy to grow just a little bit better. That, to me, when that starts to happen, is going to be an explosive device on the emerging market economies. We're going to watch these close. We will add to the emerging market sectors as they fall into our relative strength category and in our portfolio, but that would be the other that I would really watch for the relative strength to increase, the trends to continue on the upside. If that happens, I think one of the most explosive areas for 2012 will continue to be many of the emerging market economies. This is Brian Resney with Resney Wealth Management. If you're concerned about your portfolio, start 2012 off right. Call our office for a consultation. We do have a minimum account size, of course, but we do offer a free consultation if you're within that minimum. Call us up. Don't go it alone. If you keep doing exactly what you're doing before and expecting different results, I'm sorry, that's not going to happen. You need to make change and do what's right for you, not for that so-called advisor. If you're not happy, if the advice you're getting is not working, call us. We'd love to sit down with you, no obligation, talk about what we do. We'll take a look at what you're doing. Maybe we can actually help you get your portfolio back on track, not only for 2012, but for the next 15 or 20 years of your retirement. This is Brian Resney. Have a great holiday season.